Welcome, everyone, to the August 2026 edition of the ClearVista Financial Perspectives. I'm Mark Trice, and I appreciate you taking some time today to join me for our monthly market update. This one's all about the charts. We're going to go through a lot of data that came out in the last week. We'll talk a little bit about some earnings reports towards the end of the program today and get you thinking about some of this AI stuff and what to make of it as we get into the program. So here's what we're going to cover. We're going to do market updates, and we're going to talk about the market recap, if you will, for the month. It was a bumpy month. Most of the indices declined during the month of July. We'll also give you a little bit of an economic update with what data we have as of this program. And then we'll talk about, as always, the impact and things you need to be considering. So first, the market recap. So in looking at, in hindsight, in the last month, almost all the indices, in fact, all the indices were negative for the month. The S&P 500 was down just a little bit in July. NASDAQ took a hit with a lot of volatility amongst the AI companies in the month of July. NASDAQ down 3.2%. The Russell 2000 also, small caps, that was down 3%, and the moderate index was also kind of similar to the S&P index, down 0.1%. I don't have this on here, but interesting to note for the month of July was the long-term Treasuries index that we follow. It was down 4.4% as yields rose during the month of July. In fact, toward the end of the month, we saw the highest mortgage rates in well over a year. We expect some volatility during the summertime. We didn't expect as much in July. You can look at our seasonal volatility index, and you would think that July would be a little bit more calm, as it usually is, but that was not the case for July of 2026. And so we want to make sure that we realize that past performance is not indicative of future results, as they always say on the commercials on TV. But volatility, we are coming into a period that historically is a higher volatile time. Kind of going through August through the end of September. We expect a bumpy ride. So don't be alarmed. It is normal. And let's look a little bit here at I included this last month, but just to see the red dots are the pullbacks that we might see typically and historically in the past. Even this year, we've had in the S&P 500, we pulled back as much as 9% at one time. We pulled back from the highs in the month of July, recovered some toward the end, but you can see the annual performance of each of the years going back several years with the S&P 500. It is normal to have pullbacks. It is normal to have modest 10% corrections. The 20% corrections, the bear markets, those are less normal. They happen every 4 to 6 years on average. Doesn't mean that that'll be 4 to 6 years this time around, but it does happen. If you go back to the 1930s, you'll see that we will have a bear market every 4 to 6 years. Okay, so price to earnings ratios. This is the earnings ratios for all the individual stocks. This is a composite. All I'm going to point out here is we have pulled back a little bit. The latest here, I believe, is about 19.9 times earnings for the stock price. We are not anywhere near where we were in the tech bubble in the early 2000s. I know a lot of people have been comparing this time period with artificial intelligence to the tech bubble back in the 2000s. I will comment on that in just a little bit, but I think there's some similarities, but I don't think it's the same thing as we had last time. So looking at stocks over time, this is what we like to see. A lot of people get focused on the downturns and want to avoid those at all costs. And what they'd end up doing is costing themselves over time, because generally, at least since the 1930s, the stock market has trended in an upward direction. So how are we doing year to date here? Let's look at some of the top performing asset classes. Here, I've loved this little performance quilt we show from time to time. This year, commodities are performing well. That's because of the early run up in gold and silver in the beginning of the year. Emerging markets are doing well, and you see the S&P is kind of in the middle of the pack there at around 10% year to date through the July 31st. Okay, and I got some more disclosures here we have to read. Take your time. There will be a quiz at the end of today's program. Just as a reminder, I forgot to do this at the beginning of the program. You can text us at 254-282-0495, 254-282-0495. We'll try to answer the questions on the program today. If we don't, we'll get back with you within 24 hours. So let's jump into some data here. First of all, the Federal Reserve met and they held rates steady again. There was a little bit of a dissension amongst the 10 governors. Seven of the regional governors voted to hold the rates, and then three governors actually voted to increase rates going forward, mainly because of inflation being a little bit stubborn here in the last few months. And interesting enough, former Chairman Jerome Powell was not one of those dissenters. It's kind of a weird situation for Chairman Kevin Warsh. The new chairman's been in control for about a couple of months, but this is one of the first times that the preceding chairman stayed around, and so he has a heavy influence in things. But we'll continue to watch that. Their next meeting will be in September, and that will depend upon whether or not they raise rates, cut rates, will depend upon the data that they see. Now, the data that came out showed just a couple of days later showed that interest actually fell just a little bit in the month of July. And so that's good. We'll get into that in just a minute. But the markets they've been pricing in rate cuts or rate increases and things, and the markets reduce the odds of a September interest rate hike quite a bit. But they still expect one later this year. Now, early in the spring, when they're meeting there was a prediction that maybe markets were pricing in 2 quarter point interest rate increases this year. Now those odds have dropped to about one interest rate increase this year. All right. Sometimes I show the Federal Reserve balance sheet. This is real important when it comes to money supply, and you can see here that we've kind of trended back to the trend line here, certainly lower than we were in 2020 to 2022 and 23 when so much money was pumped into our economy, which caused inflation to rise. Treasury yield curve again, you can see the 30-year Treasury. This was as of July 31st. 30-year Treasury had a yield of 5.27%, and that is higher than the last quarter. As I mentioned early in the program, that's higher than the last quarter. And we saw the highest rates on mortgages than we've seen in a year. So that higher interest rate has an inverse impact on the value of a bond. And so as interest rates rise, the value of the bond falls. And so that's probably why you saw bond performances, especially in that long-term Treasury index that we mentioned, fall 4.4%. So those things can have an impact on each other. Now, the 10-year and the 2-year yields, they also went up in July. The 10-year, which is where a lot of credit card rates and also auto loans and home and mortgage and so forth are pegged. Similar to that, the 10-year yield was 4.75%. The 2-year was 4.28%. I don't think we're going to see another inversion like we saw in 2022, but we will watch that yield curve to see how it grows. Now, GDP growth also came out. In the second quarter, the economy slowed to a 1.5% growth rate. That was down from 2.1% annualized growth rate in the first quarter. But the economy did, in fact, continue to expand. And so consumer spending and business investment remain the primary drivers of growth. AI, technology, and data center spending provided substantial support. Remember last time I talked about GDP growth in 2025 and how 92%, according to one study, was being covered by the investments in building of data centers. Without that data center support and growth in those areas, GDP growth would have likely been below 1% for the second quarter. The core GDP rose a strong 3.9%. That's suggesting healthier private sector spending beneath the headline core rate. So higher oil prices obviously influenced growth rates. We saw a lot of volatility. I know we have a Casey's gas station down the street from our office, and the price of gas will change 3 times a day. It's the most frustrating thing because I go by and I think it's $2.99 in the morning, and I say to myself, I want to go fill up today. And by the time I get there at lunchtime, it's back up above 3.50. So I know it's struggle for most people to have to deal with that frustration of such volatile energy prices, but that's the environment we're in. We saw them drop earlier this week once there's a potential for a deal with Iran was announced, but we'll have to see. Though that effect, the up and down seesaw yo-yo effect, whatever you want to call it, that's keeping inflation persistent. And it may influence the Fed decisions going forward of whether or not they're going to have an interest rate hike. But the one thing that's interesting about the economy is that the jobless claims and so forth were low in the month of July. So we saw them actually fall. So when it comes to inflation, the consumer price index, that's the CPI, it fell just a little bit more than expected, driven largely at the time lower energy prices when we had some peace in the Middle East. In the last week, that's risen again and fallen again. Core inflation in this situation was flat, with softer housing costs and price declines across several categories. But inflation does remain above the Fed's target, so policymakers are unlikely to declare victory just yet. This report on the CPI does reduce, and this is what happened at the meeting this last week with the Federal Reserve, does reduce the pressure on the Federal Reserve for an immediate rate hike. So we'll have to watch and see what goes on there and to see if that situation changes. This shouldn't be up there. Consumer spending rose again in July. Retail sales were up 6.7%. That is above the median average growth. And so that's good. And we see that as a positive impact on the economy, positive influence on the economy. Unemployment rates actually dropped in July. And we look at two different employment rates. I look at the U3, and that's the general report you hear on the news. And right now, it was 4.2%. The U6, which is what we call when someone's underemployed, that was up at 7.9%. That seems to be rising in recent months, but it did fall in the month of July. So a lot of data here. I think what the impact here is, one of the things that I'm watching and we're watching in our office is all this AI investment and AI spending. Can it be sustained over the long haul? What's interesting, some people say this looks similar to the early 2000s with the tech bubble then. I think it's much different than now. These companies actually have some revenues, whereas back in the 2000s, we would have companies that had absolutely no revenues, and we were pricing them in the markets based on the number of impressions that were made or eyeballs that saw their various websites. There's a lot of spending going on, but what I'm seeing is that spending is a little bit of a circular relationship. One big company commits to buying chips from a for my AI chip maker. And in turn, the company that's buying the chips or the company that's selling the chips says, we're going to invest a lot of money into your company by buying servers and components and things like that. So there's just this, you buy from me, I'll buy from you. And that money is not, it's a circular relationship. I wish I had the time and I wish I was smart enough to do some input and output analysis to see if that's really impacting the economy in the way that we think. It doesn't seem like that can be sustained for the long haul, but we'll see. They keep spending. Earnings reports that have come out for some of the large companies that are investing heavily in AI, some of them are showing that they have no free cash flow. That's a problem. Revenues are growing, and that's good, but their spending is going up. And so we're going to need to watch this over time when we look at the fundamentals of all these companies, especially the ones that we're invested in, to make sure that this is sustainable for the long haul and in fact is just not a ruse like it was in 2000 with the tech bubble at that time. I don't think it is, but we do need to watch because there are going to be winners and there are going to be losers. And we don't know yet who are going to be the big AI winners in this particular rapid advancement in technology. So we'll just keep an eye on that. So you want to make sure that you're talking to your advisor. Ask them good questions. Make sure they understand the investments that you're in. I've seen a lot of people that have an advisor and they come talk to us and they realize that their advisor was really struggling to understand what it was they're investing in. They were just getting direction from the home office as to what they were supposed to put their clients in. Make sure your advisor is on top of what you're invested in. And don't panic when you have these short-term volatility in the market. In July, it was day to day. We have an up day, we have a down day. The market's indices, most of them ended down for the month, but we're looking at this from a long-term goal. Remember that chart I showed you of the S&P 500 over the last really almost 100 years, 90 years, and how that trajectory was upward and to the right. You want to avoid decisions driven by headlines. Certainly artificial intelligence. We've done a lot of testing on AI chatbots and different things like that, examining portfolios. And a lot of times, folks, they're just absolutely wrong, or they do what we call hallucinating. And so make sure you're not taking your advice from an artificial intelligence agent. That is not the way to do it. You want to make sound investments based on fundamentals with that, and you certainly want to avoid the political bias. I know I've seen a few people that are concerned about midterm elections. Well, folks, it happens. Elections happen every 2 years, and in some states that are on the odd cycle, there's an election every year. So don't be driven by political bias because I guarantee you the political bias doesn't impact your portfolio as much as you think it does. And so make sure you're making those informed decisions and talk to your advisor about these situations so that you don't make a poor decision based on emotion. Retirement, and so many people are ignoring their 401ks because they've been growing a little bit. That is the wrong strategy. We can give you a free consultation to help you evaluate your portfolio and give you some additional options. And we have some new tools that you can use to help you have potentially better performance than just simply the buy and hold or the index fund, or excuse me, the market target date fund in your portfolio, which so many people are defaulting to because that's what their employer put them into. All right, so for your financial plan, look at your statements, see how you did relative to the indices. If you did a lot worse than the major indices that we showed you today, make sure you're talking to your advisor. Talk to a professional about all major decisions and make sure you're educating yourself. But read different sources. I don't pay attention to the television business channels because they are promoting a product. Every person that comes on there is promoting a product. And so you never know. I mean, we talked about this in our office. I could go on Bloomberg if I wanted to, if I was willing to pay lots and lots of money to talk on Bloomberg, they would put me on there. And so that's what happens on all these television shows that are focused on business. They are simply paying for the privilege to be on there and talk about their product. Well, folks, if you have questions, you can email us at info@clearvistafinancial.com or text us at 254-282-0495. That's a text-only line. Don't call that line. If you want to call us and schedule an appointment, you can call us at 800-491-4508, 800-491-4508. And as always, we will provide a complimentary consultation, just someone to give you thoughts on your current portfolio, see if you're on the right path for your financial journey towards retirement or those near-term financial goals. And until next time, folks, we'll be having the next market update on September the 3rd. That's before Labor Day. So before you cut out for the long Labor Day holiday, make sure you tune in on September the 3rd at 10 a.m. Central Time for the next ClearVista Financial Perspectives market update. Until next time, we thank you for joining us and we appreciate your attention. Thanks.
Securities offered through Cambridge Investment Research Incorporated, a broker-dealer, member FINRA SIPC. Advisory services through Cambridge Investment Research Advisors Incorporated, a registered investment advisor. Cambridge and ClearVista Financial are not affiliated. Discussions in the show should not be construed as recommendations or investment advice. Always consult with your investment professional before making important investment decisions.